Good afternoon, everybody. Welcome to the first webinar for the 12B Green Energy Fund. It's a pleasure to have you here this afternoon, and I trust that it will be enlightening. We're extremely humbled by the amount of interest that we've had in the 12B Green Energy Fund from the press, from investors, and from yourselves joining us today. I'd like to take the opportunity to thank the Grovest team for their tireless effort in putting this product into work. It's been months and months of work, dotting the I's, crossing the T's, getting the various opinions and legal drafts out. So thank you to the team, very, very much appreciated. Again, Grovest, being the leader in alternative asset investing, are the pioneers in launching the 12B product, and which today we will share with you the opportunity for you to get involved. Just some housekeeping rules. Please feel free to post your Q&A on the chat line, and we will address it at the end of the session. There is CPD points available for those who require them. Please email Jenna and she will give you your certificate. Please note it is important that you are present for the whole session in order to qualify for your CPD points. Okay, there will be some polls. Please look out for some polls and we'll share the results with you at the end of the session. So without any further ado, I'd like to introduce my two guests. Welcome, Albertus Marais, Adriaan Erasmus. Albertus is the CEO of AJM Tax Advisory, and Adriaan Erasmus, the CEO of Hooray Power. Welcome, guys. And I would just, rather than me introduce you, can I ask you to introduce yourself? So over to you, Albertus.
Oh, goodness. Jeff, yeah, I'm a partner at a firm, as you said, AJM. It's a tax consultancy business. We have looked historically and worked with yourselves in the past, specifically on venture capital companies and the incentives around that. That incentive is, of course, expired or finished in, 30 June 2021. And I'm quite excited about today's discussion because this may be a potential alternative to look for investors looking to use legitimate tax allowances to do some greater good and also to get a tax break in the process.
Thanks, Albertus. Adriaan, over to you. Some introductory from yourself.
Thank you, Jeff. I'm the CEO of Hooray Power. We're a company that is specialized in the installation and management of large central battery systems, firstly just in the residential space, but as of recent also in the commercial and industrial space. Thanks to Eskom, we really had been able to blossom in this market recently. There's been a massive increase in not just the interest, but the uptake. And yeah, thus us partnering with yourselves to be able to fund this program.
Okay, great. Well, we're looking forward to an interesting hour of conversation. So Albertus, I'm going to put you on the spot. This is about 12B. As you said, it's potentially a replacement of 12J. Tell us about 12B and the benefits and where its history and where it is now and what it means in layman's terms.
Yeah, Jeff, so perhaps let's preface it with a comment dealing with what happened in the budget this year. I think everyone's quite excited to hear what is happening with solar. I mean, we all know that our discussion today is linked to that. In the budget this year, we had an announcement of two relief mechanisms from a tax perspective that's been introduced to our tax legislation. The first relates to individuals who would install solar on the rooftops. They qualify for a rebate. In other words, a tax credit of up to 15,000 Rand, calculated as 25% of whatever you spend. But 15,000 is the cap. So yes, it is an incentive. It's not, I think, a massive incentive, but it's aimed at households. The second one is perhaps more exciting, and that relates exactly and specifically to Section 12B. And it's a somewhat, I think, more gratuitous allowance. What Section 12B is it's an allowance. It allows a deduction against taxable income. So what you'd have is not individuals, can be individuals, but also trusts, businesses, anyone creating income through a business. If you were to invest and buy certain assets in the ordinary course of your business, we all know, for example, computers and cars and equipment in the workplace, furniture would be capable of being written down, both for accounting purposes, but also for tax purposes. You claim wear and tear against these assets as they reduce in value. Now, what Section 12B does is very much the same. It has a specific provision dealing with solar power. It says that if you are going to generate solar, and each unit generating solar generates solar at less than 1 megawatt, in other words, it's a small type of generating capacity per asset, then you can write off the entire asset's cost in year one. If it's more than 1 megawatt, you have a 3-year deduction, 50% in year one, 30%, 20%. So it's an allowance, it's wear and tear, it's depreciation really that you claim. What makes Section 12B particularly interesting, and specifically for this year's budget, what government wants to do, because of the electricity crisis that we have in this country, is to make this incentive more than just an allowance, is to make it an incentive, to encourage people to invest in solar, to buy these types of assets. Now, what government has done is to expand it twofold. The first is to say, if the electricity generating capacity is in excess of 1 megawatt, then we're going to allow all the deductions in year one in any event. So you don't need to spread it over 3 years. It's no longer 50, 30, 20. It's everything immediately. So that's the first rather significant allowance or amendment rather proposed. The second is to say that we're increasing the 100% to 125%. Now, what this means is that if I invest in an asset, just because I buy solar panels, which I use in my business to generate electricity, be it for my own business or to sell electricity, means that I can immediately claim 125% of my investment. Now, that's quite significant. What it means really, and there's no cap on this, if I'm going to buy a solar panel for 1 million rand, it means I immediately get a 1.25 million rand deduction. And that, of course, is quite attractive. So the expectation is that we are going to see hopefully a rather significant uptick in people investing in these types of assets. You'll have seen in a recent Business Day article that the expectation is that the uptake is going to be so significant that it's going to take or make a significant dent in the revenues of municipalities. And that's the expectation. Of course, this incentive is also not going to last forever. If you're going to invest in solar, you need to do so quickly. The incentive in 12B, this expanded incentive, will only last until 28 February 2025. So if you're going to invest in solar, do so within the next 2 years.
So Grovest has set up a fund, which is a 12B Green Energy Fund, which is an incommodant partnership structure, which allows taxpayers or investors, limited partners, to invest into this structure, and whereby those funds would then be used to acquire solar equipment, which may include panels, batteries, inverters, and the like, which that would be deployed to, let's say, sectional title complexes, commercial industrial buildings, call them off-takers, who will then purchase electricity from the partnership. Can you, going back to you, Albertus, this incommodant partnership, again, in layman's terms, what does it mean, and how does it affect the investor, or in this case, the taxpayer?
Yeah, so Jeff, I'm always cautious when people throw around the word we're setting up a fund, because a fund is, in tax parlance, there isn't such a thing. You can only invest in a company. in tax. So what we mean by creating a fund, or as you mentioned, an uncommon deed partnership, is a specific type of partnership. So what you say really is that the investors are going to enter into a partnership with one another. Why this partnership is different or special is for two reasons. An uncommon deed partnership is two distinct factors which distinguishes it from an ordinary partnership. What it is, firstly, is to say that you have one managing partner. In other words, all of the partners needn't always be involved in the management. You have one partner contracting on behalf of the other partners, investing in assets and selling electricity. So that makes administratively a lot of sense. It makes things easier. That's the first point. The second one is that it's also an anonymous partnership. In other words, that you needn't have all of the partners not only participate in agreements being concluded in terms of the partnership mandate, but they also needn't be disclosed for what it's worth. None of this is particularly attractive necessarily to potential investors. What is attractive is that because of the Income Tax Act's provisions, if you are a member of a partnership and one of the partners are engaged in a trade, a business for the partnership, in this case, let's call it the management partner, then everyone is engaged in a trade or deemed to be part of a trade. Now, why trade is important is that you need to trade to be able to claim a deduction. In other words, normally investors in solar panels can only claim this 125% deduction if they run an active business. Not so if you're going to invest in an uncommon deed partnership, specifically this one, because the partnership is already running an active business. It's selling electricity, which it generates from these solar panels. In other words, it allows for passive investors too to become partners in this partnership and claim this deduction, which it wouldn't otherwise have been able to do. So that in broad terms is what it allows from a tax perspective. The other attractive part from a commercial perspective is that because you're a limited partner in this uncommon deed partnership, means also that your liability is limited. A lot of people I know are concerned because they know that the principle in South African common law is that partners are personally liable vis-a-vis the liabilities of other partners of the partnership. Not so in an uncommon deed partnership. You're not at risk for the liabilities of the partnership. All that you have to lose potentially, and again, I can't see this being a very high risk investment, all that you have to lose potentially at worst is what you've contributed to the partnership. The same as had you invested in a company, for example.
Thanks for that. So just in summary, if an investor invests into the partnership, they invest 100,000 Rand, they would then be entitled to 125%, which is what 125,000 Rand deduction from the taxable income in the year in which the equipment in which your partnership owns starts producing energy.
Absolutely, that's correct. And Jeff, I should highlight at this stage, just because of the historic knowledge that we have from what happened with 12J and people being skeptic to become involved because they said, well, isn't this some sort of a scheme or tax avoidance of some nature? This is an incentive. Government quite often enacts incentives to encourage people to behave in one way or another, to invest in a certain type of asset. And this is exactly what this is. Government is inviting, encouraging taxpayers to become partners in funds like these, to invest in these products, to ensure that we have an alternative electricity generating capacity in this country as opposed to Eskom. So it's not a tax scheme at all. This is something that government wants to incentivize, wants to encourage.
Adriaan, you thought that I forgot about you. So tell us a little bit about Hooray Power. So obviously you mentioned that you've been in the market for the last 4 years. Tell us the type of installations that Hooray have done to date, what they're currently doing, the type of equipment that they utilize, and a little bit about what we call you guys to be an EPC, an engineering, procurement, and construction company. Tell us a little bit about Hooray, the details, and how you operate.
Okay. Thanks for that, Jeff. So we take a slightly different approach to the way that typically people would have gotten a battery system or a solar system. So we would go to a body corporate where individually households would in the past have gotten their own solar system, or in some cases a few panels that were dedicated to specific households. And what we do instead is we build one central battery system, one industrial scale solar system that then feeds everything and everybody inside of that complex. We're then able to achieve a much lower price point, so much so to the point where it's able to fund it through some means where it effectively becomes a cost replacement. So rather than paying COJ, they are now paying towards the system instead. And we're able to achieve a price point in the orders of magnitude that is as much as a third less than what they would have paid had they got their own individual system. Would they have needed to run their geysers, a stove, oven, kettle, etc. And now people are able to, without any impact to their apartments or their specific house, actually get the benefit of the system. So they don't have to now go and give up some space to a battery system, an inverter system. They don't have to have essentials and non-essentials. And then when they go outside of their apartment, the lifts aren't working, the common area lights and security aren't. So we've taken a very different approach, but to allow this to be possible, we've had to develop a very unique and proprietary software package that allows us to use the smart meters and a number of other IoT devices. So we can turn off, as an example, somebody's geyser if there's load shedding at night so that they don't waste their battery power heating water. Another example is to ensure that people don't abuse the system overnight, that everybody gets their fair share. We use smart meters, and in doing so, everybody gets a simulated or virtual battery. So once you've finished your share of the battery, your house will be turned on. And in doing so, people are able to get a lot more out of the system, and they're able to benefit from not just their houses being backed up, but in fact, the common areas, the lifts, the security systems, etc. So from that approach, it's a holistic solution. We're not looking stopgap measures to keep the lifts running, use a generator. We're not looking for just lights and plugs. And as the situation continues to evolve in the country and having to add more and more to that system, instead we're taking the approach of from the start, we put the right system in, we build a complete solution that caters for everything and everybody's needs inside of that gated community. For our commercial and industrial users, the primary function would be to be able to have a slightly larger solar system. So with your excess solar power during the day, you can use that to charge up a battery. And the true cost saving actually comes in when you're able to actually run the generator a lot less, or in some cases not at all. So when there's regular load shedding that lasts 2, 4, and in some cases unfortunately 6 hours, the generator doesn't have to run, even if these outages are at night. And our clients are seeing cost savings of hundreds of thousands of rands a month over and above the cost of the system itself. So from a financial point of view, it makes huge operational sense to the commercial and industrial users. And then for the residential application, we found that it allows people to really solve a problem in a holistic way, rather than stopgap measures for individual users or for individual applications.
So let me ask this question. What makes your, let's say, installation or your solution different from any other solar provider?
So look, a lot of the equipment we use is off the shelf. So we use 3-in-1 batteries, we use TES inverters, tier 1 panels. So that in that way, we are no different to any of your other top tier EPCs. What does differentiate us is the way that we use this equipment, the way that we're able to apply it, and how we're able to extract maximum value out of this. So namely through our operating procedures, so the software systems in the residential application, allowing people now to suddenly use the system and allowing people to be held responsible for the energy that they use. So if you didn't have this managed system, as an example, suddenly you would only get 2 to 4 hours of backup during peak periods, because everybody's geysers would be coming on. People would all try and do their laundry or dishes or whatever the case may have been. before his neighbor does the same and then depletes the battery. Suddenly, when you've got everybody responsible for their own share of the battery, people are a lot more conservative, and they understand that if I spread my usage over a period of time, they can take ownership and responsibility for the way that they use the battery power, rather than it being a collective where everybody tries to get the most out of it as soon as possible.
Am I right in saying that you monitor these installations on a 24-hour basis from a remote control room?
That's correct. So we have had to establish a control room that's manned 24 hours a day. And this is one of the tools that we use to align clients' expectations to reality. Because the batteries are only so big. Solar system can only generate so much power. And oftentimes people don't really understand this, be it even managers in big businesses, that they expect the power to always be on. They think it's this magic thing, which it isn't. And you need to align what the system can do with what the client can afford. And the only way that you can do that is with active management. So that this requires the battery to be charged overnight with the grid. So unfortunately, when we've got stage 6 and up load shedding, oftentimes there'll be an outage for 4 hours, hours back on for an hour or two, and then it's off again for 4 hours or longer. And the only way that you can expect the system to last for that period of time is actually when you top up the battery overnight. Other things that of this nature would be our call-out teams, people that can attend to these kinds of issues, even after hours, in the event of a major breakdown or critical failure. And those are the kinds of things that we have to implement to be able to get the equipment to perform in the way that the people, be it unreasonable, but they still have an expectation that the power is always going to be on. And you need to do what you can with the limited equipment that they can afford to actually be able to achieve that desired outcome.
Okay, so great. So and my understanding is that Hooray Power, which is a strategic partner to the 12B Green Energy Fund as an EPC, would source various projects. They would then do a potential costing and proposal that would be sent to the 12B Green Energy Fund Investment Committee, who would then vet that proposal for returns to investor as well as a counterparty risk, i.e. can they pay and for the electricity generated. Once that has passed the muster from the credit committee, that then gets offered to the off-taker, whether it be a commercial, industrial business, or alternatively a sectional title unit, who would then have a SGM and approve the proposal, and then you would then go and build such solution. How long does that solution take from the time, let's say, from the time the SGM has taken place, which is a special general meeting of the sectional body corporate, to the time that you can actually get power produced at that particular project?
So it largely depends on the specifics of that project. So smaller estate or client would need perhaps as little as 6 weeks for a system from when we get the order to when the system can be turned on and producing energy for the first time. And then for our larger projects with more complexity, a lot more equipment that needs to be installed, these can take as long as 2 months, 3 at most if we have some challenges on site, but generally you wouldn't have it run over any further than that in the worst case scenario.
Albertus, so now that the project has been installed, the project is, or it's generating electricity, the partnership is now receiving income, and it now makes distributions to the investor. How does the investor account, one, for its 12B allowance in its hands, and secondly, for the distributions being share of profits from the partnerships on an annual basis?
So a partnership is in law not a person. So when someone says that I'm investing in a partnership, it's not strictly correct. What you're doing is you're investing in something together with partners. So it's not as though I'm investing in a company and the company needs to distribute dividends to me. As the partnership makes profits and incurs expenses, it is on behalf of all of the partners. So what will typically happen is that if I were to invest in the Grovest fund now, Jeff, let's say I invest 100,000 Rand. I get a 125,000 Rand deduction, which I can set off either against income that I now earn from other sources, let's say from my firm, my salary. To the extent that I don't use the deduction, it can be used to be offset against income of that I receive from the partnership or as part of the partnership. If it's not utilized immediately, I can carry it forward because it is part of a trade. As I said, I'm doing this in partnership. So if I have a so-called assessed loss, my deduction exceeds whatever my income would have been, that excess I can carry forward and use in future years to offset future years' income, be it from the partnership or other income. Once income is being generated, which is likely to be from the start, of course, these projects are, I understand, already being lined up. The income is shared amongst the partners in the profit sharing ratios. In other words, in the ratio that the percentage that you've subscribed for in the partnership. So that part accrues to you directly. It's not as though you need to wait for the partnership to say that we are making a distribution this year. So it's not in the hands of an investment committee or directors deciding whether to distribute dividends. It's actually a very free model. So it allows for the immediate sharing of profits, which is quite beneficial, I think. So I think the important part to appreciate is that this is different from a company. A partnership doesn't have separate legal personality, if one gets technical about it. I'm part of a partnership, albeit a limited partner, meaning I'm protected, as you would be very much to the same extent as you would be if you subscribe for a company. Yet I have these advantages, such as profits accruing immediately without it being subject to the discretion of someone else. The deduction being capable of being carried forward, it's my deduction, it's not someone else's deduction. So there's a free flow of advantages, really.
So just for clarity, the 12B deduction can shield all types of taxable income, which may include salary, obviously distributions from the partnership, capital gains tax, rental income, interest income. Am I correct in saying that?
Absolutely. So the deduction is available not only against partnership income, it's applicable against anything. You can use it against, as you say, capital gains, rental income, salary income, whatever other types of income you may receive, passive or active, it doesn't matter. And whether in the present year or carried forward to the future.
So in 12J, there was a cap for company or individuals and trusts. You could only invest 2.5 million into a Section 12J venture capital company and 5 million for companies. In the case of investing in the 12B green energy partnership, which is there any cap limited? Does Section 12B limit any amount of the investment that you can invest into the partnership?
So, Jeff, firstly, no, there isn't a limitation. So you can invest pretty much as you want. And what I want to add there is you'll remember that when Section 12J started, it was also unlimited, and government said, oh, no, we didn't want people to invest this much in 12J. So then they introduced these caps. I think it's important to understand that the rationale for introducing this allowance here is vastly different than from what we had in 12J. I think the government has already learned its lesson from 12J. where it said, okay, no, we don't want such a gratuitous allowance. We're not going to allow people to invest everything. Because they've learned those lessons and haven't imposed those limitations in 12B as well, leads me to believe that it is highly unlikely that there will ever be a limitation introduced, especially considering that it's only available for 2 years on these gratuitous terms. In other words, if you want to benefit from the 125% deduction, invest as soon as possible.
Right. Adriaan, I mean, we've learned to 12B that the monies invested into the 12B Green Energy Fund needs to be deployed into projects. And in order to claim the accelerated wear and tear allowance, the projects need to generate electricity. So tell us about Hooray Power's pipeline, the average amount per or let's say project that, and how and the capacity that you have in Hooray Power to deploy on a monthly basis.
So we started back in 2019, and we've been fortunate enough to have a chance to kind of, I wouldn't say prepare for this because nobody expected the situation to deteriorate to the point where it is. But it did give us a lot of time to build processes, procedures, scale the business to the point where we are now. And last year we were fortunate enough to do, I think it was roughly 10-fold what we did the previous year. So this year we're looking to do about 5-fold on that. We've already closed 3 projects this month, so we're on track to make our target for the year. And based on our targets, we need to have full 250 million rands worth of signed projects come mid-November of this year. That'll give us enough time to have everything fully operational before the end of the tax year.
Are you confident that you will meet you'll meet that challenge?
Yeah, we have to adapt to the situation. It's never easy. We are expanding the team quite aggressively at the moment. We've got a lot of very skilled, very sought after people that are joining the team. The suppliers are able to meet the demand. It's not a problem that we need to find customers at the moment. We're actually fortunate enough to be able to turn down undesirable clients or such. And it's really a matter of being able to continue with the growth trajectory that we have for the last few years, and with the additional capacity of the extra people that have joined our team. Me and the other people within the company are very confident that we can achieve that at the very least.
Great. So Albertus, just if an investor makes an investment into the 12B Green Energy Fund and they need to exit, what is the tax consequences of an investor exiting a partnership at any time? It could be during the 10-year term or at 10-year term.
Yeah, so whatever happens when you exit, the principle is that to the extent that you've obtained an allowance initially, we will reverse that allowance when you exit. So there's a so-called recoupment. But what makes this quite special is that the recoupment can only be up to 100%. So you get a deduction for 125%, and the recoupment that you include again, can only what you get back out of the fund can only be up to 100%. So there is a permanent saving of at least 25%. The other matter to remember, of course, is that yes, there's a recoupment. In other words, there is a paying back of the allowance and then an amount that needs to be paid to SARS again at the end of the lifetime of this thing. But the longer you stay in, the longer this benefit runs, because what it effectively is, it's an interest-free loan against government. If I can get a deduction now, only to have a recoupment again in years to come, it's after 30 years, then I get a deduction now at 125% and an inclusion at 100% in 30 years' time, meaning that the 100% is a delay in tax. It's for as long as I stay in the partnership, a mechanism to ensure that I effectively get an interest-free loan from government for the part of tax that I needn't have paid because I invested in this fund. And that's a significant advantage. But Jeff, there's another thing that I also want to raise, just linked to your earlier comment on the limitations to invest in these funds, or the absence thereof, I should say. I foresee and anticipate that a number of investors will likely go to borrow to gear these investments. Say, look, I have savings, I want to invest, but this is so attractive that I potentially want to borrow from the bank to be able to make a more significant investment. Now, the question would be, can you deduct the interest that you pay to the bank? Because obviously, I mean, then that makes the interest on a post-tax basis much cheaper. And the answer is yes, you can. The requirements for deducting interest in the Income Tax Act is that you need to incur that interest in pursuance of trade. Now, we've dealt that because you're investing to invest in a partnership. It's part of a trade if the partnership is trading, as it will here. The second is if it's in the production of income. Will you be making income with this interest? Yes, you will. The partnership will be selling electricity and distributing the proceeds thereof to its partners. So absolutely, that interest can be deducted. So this is important, especially for passive investors who are currently, for example, individuals that aren't involved in trade of a sort, simply living off savings, for example. They are able to optimize this allowance to the extent that they receive passive income, capital gains from the realization of investments, for example, and incur or get these allowances on a post-tax funding basis. In other words, interest less what you would have paid tax on depositing those funds elsewhere, which makes the borrowings that much cheaper, of course.
Guys, we've had the time is running away with us, so we nearly an hour in, and we're talking, and we really haven't addressed questions from our audience, which are, I see this the Q&As flooding in. So I think just for some of the, if I can address some of the questions, is that someone asking what are the returns or expected returns that this fund can return to investors. So we are anticipating that investors would be able to receive 18% net of fees and taxes on the risk capital that they invest. So the risk capital is the amount that the investor makes less the tax benefits is deemed to be the risk capital, and you're looking to receive an 18% IRR on this money. Also, people are asking about distributions. There are 2 distributions that are paid biannually to investors. This would be in March and in September each year, notwithstanding that each month there is a reckoning of the profits that are attributable to each investor, and that would be then distributed twice a year. Also, the question is about reporting. There are quarterly reports to investors, which will actually give you a full update on your investment into the partnership, and this will account for your investment, the distributions, and the distributions will be broken down into your share of profits and interest received, because in your tax return, you would need to account for both of these. Also, it has been a question is, will I get a tax certificate at the end of each year? Yes, at the end of each year, you will receive a tax certificate, which will be a summary of the distributions made to you, as well as what you would be entitled to claim as your 12B allowance from your taxable income. Obviously, I'm here, we'll address more and more of these comments, and as they come in, and I will address where relevant to the various persons on the panel. Okay, guys, thank you. So those are some of your questions. We'll continue now for some further questions. People have asked, which we've addressed, a tax certificate that will be sent at the end of each year. Who can invest? It is individuals, companies, trusts, and partnerships, for that matter, can also invest into the fund. The size of the fund is 200 million for Fund 1. So Fund 1 will close the sooner of collecting the 200 million, or the 28th of February 2024. We're very confident that the fund will close a lot before that. The reason why we have made a 200 million rand cap on the first fund is that we are extremely confident that we can deploy solar kit into the market that will be generating electricity before 28th of February next year. So all investors would be able to claim the 12B allowance. I've got some other questions here, which will go is, who is the investment committee? The investment committee is made up of Derek Finlinson, who is ex-Standard Bank, 30 years, sat on the IDC investment committee for a number of years, I think 6 years, currently sits on Stanlib board. Malcolm Siegel, who is, and Derek, by the way, is independent, has no interest in the fund manager whatsoever, is completely independent. Malcolm Siegel is a shareholder in Grovest and would be indirectly a shareholder in the manager. He is a very experienced corporate financier and banker, spent a lot of time at Sasfin, was the managing partner of Grant Thornton, and he too has sat on the IDC investment committee for 10 years. And Amaresh Chetty, who is also a shareholder of Grovest and the manager, who is an experienced corporate financier, educated at Harvard, lots of experience, make up the investment committee. So there is the independent chairman with 2 other parties assisting, very experienced, making that up. Distributions can be made or will be made biannually. And then there's obviously the questions, how long is a typical offtake agreement? The typical offtake agreement is we enter into 20-year PPAs, but the fund has been modeled on that after 10 years that the PPAs would be on-sold to a third party. The reason we have done that is that obviously if you held the paper for 20 years, the returns are far greater than if you held it for 10. But for a lot of investors, 20 years seems a lifetime, which it probably is. So 10 years is typical of a fund of this nature, which is in Commandant Partnership, a GP-LP structure. And how the fund exits its investments at the end of 10 years is that we've assumed that we would sell the future cash flows of the projects at a 13.5% discount to the cash flows. How do we test that if that's reasonable? Grovest has involved through its Meta Capital fund of funds, which has had 5 vintages in the market to date, has had 2 solar portfolios that it has exited, one at 12.25% and another one at 12.75% discount, which is, so when we model 13.5% based on the information that we have at hand today, we're very comfortable that it is a conservative number. People have asked, can I continue to invest in the fund after making an initial investment? Yes, as long as the fund is open. An investor or a limited partner can continue to top up the investment, and they would continue to get their 12B allowance on any investments that they made, as long as they would get the 125 12B allowance is available from the 1st of March 23 to 28th of February 25. So as long as you made an investment into solar producing assets during that 2-year period, you would be able to claim the 12B allowance. So I think in terms of what are the returns, we have an investor pack that if anyone wants the investor pack, one can go into the detail and granular pieces of the cash flows of the investment, and happy to do that. And it's self-explanatory, so all you have to do is just send us or subscribe on apply at 12b, in the words 12b.co.za, and you can put a little description of what you require, and we will send you the investor pack only with pleasure. The question is, do you pay capital gains tax? The partnership is not a taxpayer, so therefore the partnership does not pay capital gains tax. When you actually sell your investment, you will be subject to a recoupment in your personal hands. Notwithstanding that if you invest 100 and you got 125 tax benefits, and in year 10, the value of the asset is only worth 40, you would then pay tax on a recoupment of 40 in your taxable income. We have modeled our returns based on a 40% recoupment at the end of year 10. I'm being asked about our fees. Our fees is we charge a 1% setup fee. We charge a 2% per annum management fee paid quarterly in arrear, and there's a performance fee of 20% after returning 110% of the risk capital. The risk capital is the amount that investor invests minus his tax benefit that he receives times 110%. So that is basically how we get to risk capital. Anything after returning the risk capital, the performance fees are shared 80 to the investor and 20 to the manager. Now I think there's one or two technical questions that maybe I can pass on to my panelists. Adriaan, there's some guys here or people are asking, have Hooray put in, or has anybody put in any installations into sectional title units? I think if I can call on, if I'm calling on Christian, why don't you just put some of the examples of sectional title units or commercial industrial building units that Hooray has done, the Hooray installations. Adriaan, maybe you want to talk to these?
So that's a battery system from body corporate. That specific system that was shown there was for 132 houses. This is a solar system on a super spa in the Eastern Cape. They also have a battery system that allows them to run 18, 19 hours a day without having to start their generator. Only if the power goes off for a day or two at a time does it have to start overnight to top up the battery. To date, we have, I believe it's 8 body corporates that are on the system.
Christian, why don't you just replay that clip, please?
Yeah. So that's 216 house estate in Boksburg. That's a different complex also in the East Rand. That's in the West Rand, in Raypowers. That's 31 houses. So there's a townhouse with separate houses, nothing is conjoined there. Not a big block of apartments. That's the spa. They have lots of electrical issues in that part of the country, so they're only too happy that the generator doesn't have to run all the time. So yeah, that answers all those questions.
Thank you, guys. For anyone who is interested who has a sectional title complex or a commercial industrial building that you would like Hooray Power to make contact with, please, Christian, can you put on poll 2, and then we can get some information, and then we can pass that on to Adriaan. A question has been asked is, what is the relationship between Hooray Power and Grovest? So Grovest has a significant minority stake in Hooray Power, and it has had for the last 4 years. Hooray Power has been around, as I said, for 4 years. It's probably were the preeminent and founder of large storage batteries in these sectional title complexes, and Grovest was the funder. Today, Hooray Power is the EPC of choice for the fund, but it doesn't mean that's an exclusive EPC that the 12B fund will work with. I think we're lucky to have an EPC on our in the team, on the basis that collecting the money is much easier than deploying into the various projects. So now having Hooray Power close and we keeping a beady eye on them gives us a lot of comfort that we will be able to meet and beat the expectations of 200 million rand of assets in the ground. In fact, we're looking for a lot more. The 200 odd million rand will come from Hooray itself, but we're looking for Fund 2 and Fund 3 as well. And then we will, together with Hooray and other EPCs, will look to put these projects in the ground. So I think it is fully disclosed about the related party relationship in the partnership agreement. We're very proud of our relationship with Hooray Power, as we believe that it gives us a lot more ammo in our camp, because we do not have to go and look very far in order to get our first 200 million. Okay, can we take down that post, please? Another question is if money is not immediately allocated to a project, does it accrue interest, and how does a fund account for it? Yes, all money that is sitting, it does not sit idle. It would be put into a call account in one of the big 5 banks, and that interest would then accrue to the partners who are in the partnership at that time. At the end of each month, a reckoning gets made, and a new partnership, inverted commas, gets sorted, gets prepared, and all monies that has accrued to those partners will be distributed to the partner's capital account at the end of each month. And that would include interest as well as any energy revenue that would have been generated because they may have invested at an earlier time than another investor. From a credit perspective, the investment committee is very much the decider as to if the off-taker is credit appropriate. We will not deal with any tenants. We only deal with landlords and sectional title complexes. Very interesting that sectional title complexes cannot, if you sell a unit in a sectional title complex, you cannot transfer that unit unless your levies are 100% up to date. So it also gives us some sort of comfort. I may not have, got to all the various questions, but I'm trying to run through them as best as possible. There's full insurance on full risks insurance, all risk insurance on all the projects that would cover damage from lightning, flood, any natural disaster, that we theft. We have cameras in on all of our systems, so we monitor them Hooray Power monitors them 24 hours a day from a remote control center. Question about, is there an early exit option? The fund is meant to be 10 years, but not mandatory. Firstly, if the fund felt it was beneficial to sell the portfolio in year 8, it would, and the investment committee ratified it, then they would set it in year 8. However, we have timed the maximum benefit for the holder to be 10 years. That said, should anybody wish to exit the fund before 10 years, we have exit mechanisms built into the partnership. So the partnership is extremely cash rich because it is getting contractual income on a monthly basis that escalates at CPI plus 1 or 2. That cash that gets generated every month can be used to buy back a partner's interest, beneficial interest, but it's not obligatory on behalf of the fund. And also that if the investor wishes to sell it to a third party, it can do so, as long as the third party signs a deed of adherence, which really says that they subscribe to the terms of the partnership. It can be unsold. When you sell your interest in the partnership, there will be a recoupment of the value of the assets at that particular time. Sorry guys, if I'm running ahead. It says in 12J, the high tax bracket benefit more. Will this be the case in 12B? Funny enough, it's not the case, because when we give you your 12B allowance is based on your investment at 125%. But when which you'll set off your taxable income, when we give you distributions, your distributions as well need to be included into your taxable income, but then they would be taxed at the investor's tax rate. So if an investor's tax rate was, say, 35%, he would then deduct the 12B allowance against his taxable income, and he would then only pay tax at his stipulated rate when he receives his income. The question here is, can you use leverage to maximize the participation? Absolutely. So the banks are very, very keen for these types of books. But first, they're green books. Number 2, that's a big diversified book. We have already said to you in our meta fund, we have already sold 2 books, but if leverage is not a problem, you can probably get, in some cases, depending on the quality of the off-taker, 70-30 LTV, but in most cases, we would probably go at 60-40. If we did include leverage into this fund, which the fund mandate allows, that there would be an extra 2 or 3 points to the IRR, but in addition, if we use that gearing to invest in more projects, the investor would be able to get an additional 12B allowance on the assets or that have been brought into production as a result of the additional monies that we've raised through the gearing. The financial model has not taken into account any gearing, but that is certainly an opportunity for the fund to take up. Okay, so I've been told that we've run out of time. Can I put up one last poll onto the screen, please, Christian? So this fund over here is if you would like to receive the investor pack, or you want to benefit from the 125% tax deduction, or if you would like to set up a meeting, I am available to meet each and any one of you on a Zoom call if necessary, to answer any questions and take you through the granular cash flows and any questions that you may have. So guys, while people are still filling in this last poll, I just want to firstly take the opportunity of thanking Albertus and Adriaan for their time and their valuable expertise and opinions. I'm sorry that I answered all the questions, guys, but hopefully I did a good job on your behalf. But I tried. There were many, many questions. I think there were over 50 odd questions that I tried to run through. Oh, I'm told over 100 questions, but I tried to run through them, but I think most of them were answered. So thank you, Albertus. Thank you, Adriaan, for your time and for your input. And also, very, very importantly, thank you to you, our guests and potential investors. Thank you for joining us. I hope it's been interesting. Hopefully, a lot of you will join us in this exciting journey and become investors with us in this new pathway. I think what we're doing is not only great for ourselves as an investment return, but I think it's needed for our country as a whole. I think it's going to create many, many new jobs. A whole new industry has developed, and that we all live here and our children live here. I think it's very important that we solve this crisis. So thank you very, very much for joining us. I also want to say thank you to the Grovest team for putting this webinar together and making it such a success. We had a fantastic response, and full marks to you guys. Really appreciate it. So thanks again, and please feel free to reach out to me or apply at 12b.co.za with any of your inquiries. Thanks, guys.